Accounting systems. There are two systems of accounting that are followed, that is single entry system and double entry system. First, we will see what is single entry system. It is actually an incomplete system of accounting which is followed by small businessmen. That is where the number of transactions is very less. And here only personal accounts are opened and maintained by the owner of the business. Subsidiary books are sometimes maintained, sometimes not. So since real and nominal accounts are not opened by the owner of the business, here the preparation of profit and loss account and balance sheet is not possible to ascertain the correct financial position of the business entity. Next comes the double entry system. It is the scientific system of accounts that are followed all over the world, and it was developed by Luca Pacioli of Italy in 1494. And under the double entry system of account, every entry has its dual aspects of debit and credit. It means assets of the business are always equal to the liabilities of the business. That is, if we give something, we also get something in return, and vice versa. Then, rules of debit and credit under the double entry system of accounts. These are also known as the golden rules of accounts. And this will vary depending upon the type of account. Okay. So, in the case of personal account, the golden rule is debit the receiver and credit the giver. In the case of real account, debit what comes in and credit what goes out. Nominal accounts, debit all the expenses or losses and credit all the incomes or gains. So I'll give one or two examples. For example, if Mr. A is starting a business and he introduces a capital in cash, that is rupees 50,000. So here the journal entry, how it will come? Cash account debtor to capital account. Why? Because he is introducing the capital in cash, right? So one account will be cash and one account will be capital, that we know. So what is cash? What type of account it is? Cash account is a real account. So the rule comes debit what comes in and credit what goes out. So here the cash is coming into the business. So we are debiting the cash account. Understood? Now the second account is capital account. What is a capital account? It is the owner's account, that is a personal account. Right. So, in the case of personal account, the rule is debit the receiver and credit the giver. So, here the owner is giving the money to the business. Right. So, he is giving the money. So, we should credit the giver. So, we are crediting the capital account. So, cash account debtor 50,000 to capital account 50,000. So, we saw the case of real account and personal account, and one more entry I'll take relating to nominal account. That is, if the company is paying freight charges in cash, rupees 1,000. So your one account is freight account and the other account is cash. So freight account is a nominal account, right? So the rule is debit all expenses and credit all income. So this is an expense. So we are debiting it. And cash, real account. That is, debit what comes in and credit what goes out. So here we are paying the cash. It is going out. So we are crediting it. So the entry is freight account debtor rupees 1,000 and to cash account 1,000. So I think it is clear for you. Classification accounts, golden rules of accounts, and how we are making the journal entry for this.